and for example you buy 2 contracts, one of the things you do is you just make sure you always take one out for a small profit, even if it's 4 ticks. So the price goes up 4 ticks, and you say to yourself, right, I'm bagging a single contract. Now, what a lot of people do at that stage is they're now plus 4 ticks in their profit and loss. And a lot of people will move stops to break even, +1 for example, or just simply stops at break even. And the next thing that happens, they get scratched out, and then the price goes, and they're not in any trade. And they go, damn it, I'm not in the trade. Market's now up 20 ticks. I've ended up with 4 ticks and a scratch. How the hell can I get past this? Well, one of the ways you can do to get past this is think of those 2 contracts not as 2 single contracts, but as one single trade. So if you think about this as one single trade rather than 2 contracts, which it is just one trade. Whether it's 5 contracts, 20 contracts, 200 contracts, it's still just one trade, right? But if you think about it as one trade, if I take +4, if I now put a stop in at -3, I would still make 1 tick on that trade, correct? So I would still make 1 tick profit in that trade if I get stopped out. But I'm at least giving myself room to allow myself a little bit of patience to try and figure this out. So the price is traded here, it comes back down to the entry price, I don't get stopped out at break even and it breaks north for me. And obviously at that stage you say, right, I've now got a failed auction in the background, now I can bring my stops out at break even +1. You move your stops to +1 in the remainder. Now you're at +5 for the trade, right? Now you're at +5 for the trade. Now at this stage I'll rarely ever move my stops. I'll rarely now move away from that break-even stop. I'll very rarely bring it up underneath the price unless it's gone miles away and I just don't want to get spiked in a horrible trade. And the only time I'll bring it up is when the value starting to become a little bit dubious, a little bit bearish, and I'll start saying, okay, let's bring that stop up because I think they might do a toxic sell at some stage. I want to make sure I get taken out of the trade if that's what they do. But I want to try and come off the trade myself. There's an amazing lift it gives you knowing that you're in control of the markets, not the market. It might be some sort of a fanciful idea that you have any control over the markets, but you actually do because you choose when to get stopped out. You choose when to take profits. You choose when to enter. So you have full control over it. You have full control over the part that you have control over, right? So obviously it's up to you when you're going to start moving, but if the value changes, absolutely ramp it up. Ramp it up to +5, +2, +3, +10, +100, whatever it is you're making. And then if you get stopped out, you say thank you. And then you just take a few minutes out, put your tools down, just stretch your legs, go for a coffee, and then start all over again. Right, what side do I want? What side do I want to be on? Because there shouldn't be a situation where you're going buy side and then sell side. Unless you are buying short term and then the value completely changes and you want to get the sell squeeze on, then of course you close out your buy trade and then sell it immediately because the value is now changing. But that doesn't mean you're buy side. That means you've now gone from a buy side to a sell side because of a change in value during the process of being long. In other words, you should always just be one-sided. There shouldn't be a sell, and if it breaks the bottom edge, I'm buying it. You should simply be looking at the market from one side of the trade. And the reason why that's important is because, you know, time's important for a lot of retail traders. There's a lot of things to consider. There's a lot of levels to mark off. There's a lot of different time frames to keep analyzing. There's listening to me in the room, listening to reading the chat in the room, trying to type in a couple of answers to a couple of questions. In other words, you don't have time to be two-sided unless you're an out-and-out scalper in the marketplace, unless you're doing the market maker's exercise. But even doing the market maker's exercise, you all know at some stage you end up wanting to be one side only, and you start recognizing what that side is. So it's very, very important that we start to get into a process that we make our own. It's not about whether you want to use that type of idea or not. It's about just using something that you're consistent with as you approach a market narrative. So here, for an example, we were buying bottom edge S&P. Now remember, what was the quote from last night? If you're going to trade value, you're nearly always going to be contrarian, correct? Was that a quote from last night? Somebody far bigger than I Absolutely. If you're going to trade value, you're going to be a contrarian. So when you look at the last three trades have all been kind of buy trades at bottom edges. Contrarian buying, right? Contrarian buying. And all you do is when the value changes, you start looking for the liquidity at the bottom edge. In other words, exhaustion. So when I see the value flipping and going back up, the liquidity flipping and going back up, I want to try and be a contrarian at the bottom edge. I want to try and buy that bottom edge. And sure enough, I get filled. I go from a price of 33s to a high price of 36s. I make another $150. I get another stop at break even if I want to, or I decide what to do with it. So when the value starts rolling over and then it turns back up again, I don't want to do anything with it. I'm just at break even, right? I've made some money, taken some profits. Where did I take profits? Well, where do you think I took profits? Here, right? The previous fractal ledge, I took some profits against that price. And I simply then moved my stop to break even, and I'm still in the same trade. If I get stopped out of break even, I don't care. Now, if the value starts going down, which it is at the moment, and I get back up into the top edges here, I'll be obviously starting to think to myself, right, close it out. Let's start seeing about the possibility of getting a bit of short business here. Close it out and let's get a bit of short business. Now, if the value changes and goes back up as it goes through the top edge, I won't close it out. I'll let it run again. I'll just keep letting it run. In other words, I'm in a position, and I'm in a lot of positions, but I'm patient, right? I'm patient for the right signal. I'm patient for the right idea. I'm patient for the right trade. I'm patient for the right narrative. And if it means that it costs me a +1, it costs me a +1, and I would be happy to take +1s. But if I'm always in a trade, if I'm doing a lot of trades, if this market breaks, I'm in it, right? If it breaks south, I'm not in it, but then I would never be in it. It doesn't matter what happens. I would never have been in the trade in the first place. So when we start adding some value narratives to this, when we add in, for example, our sentiment line, for example, and we start seeing that sentiment agreed with this divergence here, we can see that not only was liquidity positive for the buy trade, sentiment was positive for the buy trade as well. So buying into the lows actually had a very strong case during that period. Unfortunately, as the liquidity started to dry up here, the sentiment started to dry up as well. And obviously, if you're in that type of trade, you're going to say, well, wait a second, should I not? Well, it depends how many contracts you're trading. If you're trading one contract, then you don't have much of a choice. You probably just say, well, I'm going to close it out and I'm going to wait for something better. Close it out and wait for something better. Don't close it out when it downticks. Close it out when it's in that top edge. Because when it downticks, you've just thrown away money for no reason. You're either going to close it out on an uptick, or you're just going to leave your stops at break even +1, and you just say, thank you, I'm not going to do anything more with it until I get something happening. So I'm patient. I'm using that patience to stick around, because value changes on and off, switches bullish, switches bearish. And it's not costing me any money to recognize it happening, right? I'm in a long trade. I'm in a long trade. So now that I can see the value switching back on again, am I now happy that I'm in a long trade? Sure. Am I going to close it out at the top edge here? Not a chance. Not a chance. I'm happy to now wait to see if this develops on the upside. And it might go and make $1,000, right? It might make absolutely nothing. It might make me +1. I've already taken the trade out. I've already got half my position out at 36. I've already made $150. So the worst case is for the trade makes $150. That's the worst case scenario. I'll take that any day of the week. I'll take that any day of the week. $150, damn tootin' right. Now, obviously, I was expecting it to go higher. It has now just broke higher. So I was right. I was right to wait. You know, I was right to wait for the trade narrative. And obviously, if you're a multi-lot trader, you can see that there was a little lag on that trade. So if you're a multi-lot trader and you still have some positions, you just get ready for a possible transition to just take some profits into. You just get ready for a transition to take profits. Now, obviously, we've now got the break. So now I'm looking at it from the perspective of a measure on this. And you can see, obviously, we're on our way to this measure here. So that's pretty good. And I'll just bear that in mind as we go up. And good. Nice, easy money trade, right? Nice, easy money trade. So did you see how the patience worked for me? It didn't. It's not always going to work for you, but the worst case scenario is you're going to get scratched out at +1. But I want to try and be in a trade when it goes, right? So I'm seeing a little bit of value divergence. I'm seeing a little bit of aggregation. So guess what I'm going to do, guys? I'm going to book some money here at 39s. I bought it at 33s. I'm just booking some profits at 39 on the aggregation. And I've just made myself 6 points, $300. And I've also made $150 on the first part, which means I've made $450 per trade, which is 2 contracts. And that's a pretty good outcome, isn't it? It's a pretty good outcome. With value starting to diverge, I'm happy with my lot. If it carries on going, I'm a multi-lot trader, you're still in it. You're certainly not selling it, that's for sure. But you are taking profits on aggregation if you're a multi-lot trader. If you're a single lot trader and the value starts diverging, guess what you do? Now's the time to ramp up your stops, right? So during this phase, your stop's going to sit here. When the market breaks here and it starts to diverge into that, guess what you're going to do with your stops? Now's the time to ramp up your stops behind the price, right? Now's the time to ramp up your stops because you know that the market's starting to turn a little bit bearish here. You see aggregation up here, so you just put your stops in there now so that if it does break south, you do get taken out of the trade, but at least you're not giving back a whole wad of your profits. And you still have the luxury that if the blue line suddenly turns back up again, you're still in the trade and it still goes on to make you $1,000, right? It still goes on to make you a lot more money. Buy yourself that time, but don't give away an awful lot of cash if you get it wrong. And obviously, if the value starts turning down again, then obviously you're getting more and more inclined to say, well, let's ramp it up a little bit more because I'm really not enjoying what I'm seeing. If you ramp it up there, a few more ticks, you're just locking in that extra because this is getting very bearish now. So, good. And if you're a multi-lot trader, you might say, well, if this is getting bearish and I start seeing this sloping off, for example, I would be contemplating the possibility that there may even be a sell trade at the top edges in due course. Whether it's going to be at 40 wholesale or not, I'm not sure, but we can already start to recognize the possibility that we might be able to start working some orders against the 40 break higher. So that might be something you're starting to look at, but the break has happened. The value's just turned up again there. The value's just turned up, so I'm going to be looking at that as a multi-lot trader, and I'm going to take another little bit of profit against that 40 just there. As a multi-lot trader. I'm not selling it, just taking a bit of money. If this dropped into the red, I'd definitely be looking at a break above 40 for a possible short play into that red zone. But remember, we are just 3 minutes ahead of the cash open, guys. So 3 minutes ahead of the cash open, the market's bullish in terms of its trend. Value-wise, it's bearish. So in terms of trend, you're expecting a trend line break kind of narrative. You're obviously going to be thinking to yourself, where's the gap? Well, the gap is almost just directly above you. So obviously the gap fill would be a break above that market there. The gap fill would be a break into that market there. That would be the gap fill. But with the value bearish, you'd obviously be looking at the gap fill to then reject into a bearish short. Reject into a bearish short. You can see the sales came off the 40 right enough. Value divergence, but we're getting a bit of value coming back in again here. So we're coming into the cash open, guys, in just 3 minutes time. 3 minutes time, guys, 3 minutes.